All right, good morning. What a week. What a hell of a week. That was one of the quickest sell-offs in history in the markets as far as percentage losses in 1 week. Um, you only get to see something like this a few times in your lifetime, so congratulations. And if you made it out alive and did not blow your account, then you're doing pretty good. Um, the the amount of volume on the SPY ETF on Friday mixed with the price, so the total value exceeded 100 billion on Friday, which is the total, which broke previous records. So when I say this, it means that the price multiplied by the total volume exceeded the total value of previous records. So 290 or something like that SPY multiplied by the volume. The total volume on Friday was huge, but it wasn't a record number of shares. But the value of that volume exceeded all previous records for any ETF or ticker or anything in history. So it was an unprecedented week and an unprecedented day in the markets on Friday, as far as breaking some records and revisiting certain metrics that haven't been seen for years. So what I've got in the background is this is Telegram Daily Edge Live. It contains a ton of live feeds, some Twitter stuff that's put in there live, not any, just small latency, live stock blocks, live metric alerts, stuff from TradingView that gets pumped into there. So it's a lot of great stuff that's inside the channel, and the one thing that in particular that we were paying very close attention to were all of the blocks that were being traded on Friday, and specifically all of the dark pool blocks. So in with the bot that you actually get, you can do a few commands on demand that lets you look at some of the information for the past. I've been collecting data for, I think, about 120 days. So it goes back a decent amount, and it will continue to be stored for at least a year. So the amount of data that will be in here is going to be used to do a lot of other great metric things. So if I repaste this dark pool summary for that day, you can go back, you can put how many days you want, but just for the single day on Friday, I wanted to look at what the dark pool summary was for Friday. And Friday showed that we had 53 million shares in dark pool prints. And a lot of these are those 501k signature blocks that maybe are from Goldman Sachs using the dark pool machine. Not sure. Could be other investment banks, but a lot of those were those 501k blocks, and some of them were half that size, 250 something K, and then even half that, 125 something thousand. So these are all signature blocks that get put on the tape. And the reason why they're dark pool blocks is because they were all executed yesterday, or not yesterday, they were executed on Thursday. They were just showing up on the tape a day late. And they were showing up at the Thursday settlement close. That's the signature for dark pool late prints from the previous day. They always show up at the settlement close from the previous session. So 297.89 was the Thursday close. 205.78 was the Thursday close for VXX. This other one, this 4 million dark pool block, is something that's really important. So if I search for this price, just something to search for in Daily Edge Live, 290.63. If I search for this, you're going to see a block right here. And it's going to show you that there was a single transaction near the bottom for SPY for 4 million shares. And that occurred at 290.63, and it hit the tape at 12:30 about. So 290.63, if it hit the tape at 12:30, that means that it was executed somewhere around here. Somewhere in this region. And this was at, or maybe even over here. More likely way back here at the open or pre-market prices. And then didn't hit the tape until somewhere in this area. So it was well above where the price was actually executed at. It was $3 above at the time it was executed. So they were so eager to buy on Friday that they were willing to run these dark pool machines for maybe 3-4 hours, depending on where this happened, if it happened here or if it happened over here somewhere, and hide the transaction from the public for just a little bit, for just a couple hours. They wanted to hide that transaction. So this is a really important block, this guy. To me, these are the ultimate gift and the ultimate treasure when it comes to dark pool prints, because it shows the hand of the machines. And we had the same thing at the top near February 20th. We started to see some of these late same-day prints on XLK, which is the spider ETF for technology. And we started to see these kind of come on the tape. And those are showing the hand of big players making big moves. And we saw some more on Thursday for junk, JNK junk bonds, which took an incredible dive the following day. So this was that day that we saw those prints on Wednesday or Thursday, and then the next day was a massive sell-off. So it's just, following these blocks is really important. But to get 53 million, I haven't seen this amount of dark pool activity in SPY since the Trump election. The Trump election is what really set the stage for me to be a really big believer in dark pool blocks and using them to your advantage to follow the money of where the big players are moving the market. The big players are the ones that have all the money. The amount of dark pool activity on Friday was about 13 billion in SPY valuation. Just multiplying these shares. If you just multiply 53 million shares times this price, just to get a rough number, it comes out to about $13 billion. So these are the people that control 99.9% or more of all of the money in the markets and can move it any way that they want. And when it doesn't go in their direction that they want, they would just, they just laugh at that, call in their other, level whatever trade, level 2 traders or something, and just push the market with some reverse reserve cash in the direction that they want it to go. So this is unprecedented. The last time that I saw dark pool activity like this was the day after the Trump election, November 2016. The dark pools had already made, and the big money had already made their bets the day prior to the election. They did not care what the election outcome was going to be, no matter what they were going to buy. I doubt they knew that Trump was going to win. That would be incredible knowledge if they actually knew that ahead of time, but that's impossible to know what the voters were going to do in advance. So they already made their bets the prior day. Overnight, Dow Jones futures dropped something like 1,000 points and hit the circuit breakers in the middle of the night. So they actually got that enough movement. 1,000 points, we saw that 3 days in a row this week. But back then, for Dow Jones to move 1,000 points overnight meant a 7% correction to hit the Series 1 circuit breakers for CME Futures Exchange overnight. I think the markets went online, 15 minutes later or something like that. and then the circuit breaker hit usually triggers a bottom, or will trigger a bottom in theory, just because people get their bearings straight and buy back in. Carl Icahn stepped away from the RNC celebration meeting or wherever he was at. I don't know where he was at. Probably went out and told his private broker to go buy him $5 billion in futures. I have no idea. And then the markets took off for the rest of the pre-market session in very early hours of trading from 1 a.m. to 9 a.m. and managed to overtake the previous close and end up in the green at the open. And the buying after that was incredible. We know how that year ended in 2016. It was a banner year. It was a banner seasonality year all the way to December, January, and the rest is history. But the key thing is that the dark pools made their bets the day before, and they weren't going to let any silly election ruin their money and all of their dreams. So they pumped the market the remainder of the night back up to make all of their dark pool bets green by the morning. That's what happened, and that's the untold story of the markets that really happened. What was really a huge story that not very many people are aware of, or many people care about, or many people talk about, that happened on that election. And I have a feeling that we're experiencing something very similar on Friday with this amount of dark pools buying 53 million that we haven't seen since the Trump election, and they managed to close it green. So in the final moments of the stock of the session on Friday, in my opinion, what they were doing was they were keeping their boot on the neck of the market for as long as possible to buy as many shares as possible at the lowest prices possible. And I had a feeling that this would happen. Once I started seeing the threshold of SPY dark pool blocks cross the 40 million level, I started thinking there is a chance that they are going to let this thing mark up at the end of the session. And look at the final 15-minute volume at the end of the session. The last 15-minute candle broke just most of the day's a lot of the day's volume was that final 15 minutes, and they pushed SPY up, and after hours pushed all of these dark pool values green. 297.89, that's about here. So they pushed it $1 above that dark pool level. QQQ had no problem. That had no problem. So this, to me, right here, this was a head and shoulders of sorts. You have to see it in extended hours. You can see this head and shoulders. Let me take this. Off. They won't let me do it. Let me see if I can take the color off. There we go. We'll just do a little bit, so we can see the extended session. This is a big head and shoulders pattern. This is a good one. It's nice. It's rounded. It's equal on both sides. And the previous video that I did in the morning on Friday, I got up really early and I saw this, and I started posting this video right when we were about here, somewhere around here, and thought that we could have a. Oops, I'm doing this wrong. This guy. Something like this. Maybe this over here. Who knows? Yeah, this is fine. So the minimum target is probably back at the 200-day moving average, which is what this thin yellow line is. The 200-week moving average is further down, this fat guy down here. 50-day pink, 20-day white. But for me, the target would definitely be this 200-day moving average is about $6 above. And I'll get into that a little bit more about targets for this upcoming week. But to do this move, they pushed all of their dark pool bets green at the close. That's what the purpose of it was. It wasn't to that was the goal. So my opinion, and we look at IG markets right now, the IG weekend Wall Street. There's also weekend DAX, I believe. We're currently down 500 points from the close on Friday. The close was up here on Friday, right here. We're down 500 points. I'm not too worried about this. These are super thin markets over the weekend. They could wait all the way till 5 p.m. today, 1 hour before futures open, to push this back up. And I'm willing to bet that any gap down is a buying opportunity, and we're going to open green on Monday, maybe. That amount of dark pool buying, potentially, if it's buying, I'm nearly positive. I could be wrong, but it doesn't seem that way to me. And I'll go over a couple other reasons why. That amount of dark pool activity, they're not going to let those trades go to waste. So I want to get into just how crazy this day was. And if I look at the ETF block summary for this, further reiterates my theory. ETF block summary is the live ETF blocks, not dark pool blocks that are late same day blocks or blocks executed in the previous session. The live blocks that are the big blocks of note was just insane. These are all the live big blocks for SPY that were executed at market price during the day, and they closed them all deeply green. These are all the live QQQ blocks, and when this says 706, it's volume in thousands, so this is 706,000 shares, all closed green. And then VXX, most importantly, closed deeply in the red with some live 2 million share blocks in VXX. It's just crazy, the amount of volume. And then the day before there were some 2 million blocks too, but not two of them. And we may get back to those in the coming weeks. Backwardation for VIX futures is at a very extreme level, so it's possible that we just had a complete blow off in VIX, which has happened before. If you've traded long enough, you're going to see these big blow offs in VIX. One of them was February 2018 back here. Another big one was 2018's December back here when we hit this 200-week moving average, which is that big fat yellow EMA or a yellow SMA. So Dow Jones did not hit it, but it was a tremendous buying opportunity, as Trump would say, and he was right. He said on December 25th that it was a good time to buy stocks, and it was. And all these magazines like Bloomberg came out and said, no, Trump, you're wrong. It's a horrible time to buy stocks. It's probably the worst time ever to buy stocks. So you really have to listen to the people that have access to love Trump or hate Trump. Presidents are usually right about calling bottoms all the way back to Nixon, I think. Whenever they don't come out that often and say this is a great time to buy stocks, but when they do, I think that they have a really great track record of calling bottoms. Presidents have access to information that we don't, and Trump in the past has had to have his hands slapped for talking about good numbers for NFP, non-farm payroll numbers in advance. And on Twitter, I remember that happened one time, and people got all upset because you're not supposed to do that kind of stuff. And you're not. You're not supposed to reveal that information. It's insider information that presidents know about beforehand. And he probably has some information about if the Fed is going to do any kind of intervention here. So these blocks were amazing. This is really important that we close so deep in the green. This is buying. This is not selling. They're not going to let these blocks go deep in the green if they're shorts. So selling or buying or profit taking or both. So this little indicator that I have down here at the bottom is just it's really simple. It's not complicated. It's just taking the change of a close divided by the previous close and multiplied by 100. So it's the change in candle. And since I'm on a weekly chart, it's the change in percent from one week to the next. So this week, we crossed the negative 10% threshold for week over week change. So if you go from the previous Friday, back on the Friday before, on February 18th, the week of February 18th, and then you take the weekly change to the next week. It was what? We came out to negative 12.4% in 1 week. And that's part of the reason why I say that this particular sell-off is unprecedented, because this does not happen very often, and I want to go over some things really quick. To put it in perspective, the last time that we had something like that, a week-over-week correction like that, was back on the week of October 6, 2008, at the final throes, or one of the final bottoms of the financial crisis right after Lehman Brothers crashed. And if you look closely at this is the theme that I'm going to build. The next week, we regained over 70% of the previous week's range. So something like back then was a rise of, how much did we gain back? We gained something like, oops, let me reverse this, from the previous week's close. Why am I doing this wrong? There we go. Something like 75% on the way back up. And if you calculate this one was about, let's see, if we went from the close here from 85.50 and got back up at some point to 97.18, that is what? About a 13% gain on the way back up. But I'm only interested in the close. So let's take the close, and that's 88.52. And that was about 4.7%. So you're going to see this common theme that are somewhere around 5 to 6% close to close the next week is about the average gain the next week on a correction like this. Going back further in time, you have to look at the week of September 2001. That was the attack on the World Trade Center. So the next week after that, immediate buying, and Fed intervention here was some Fed repo intervention, that we had a dramatic Fed repo market intervention for that time period. Nothing like today. 150 billion is unprecedented, the amount of intervention that the Fed has done since September 2019. Absolutely blows anything out of the water from the 2008 financial crisis. So the gain here from close to close, %7.4%. Going back in time further, we have to go back to, and this is why I'm saying the weekly correction, week over week, we're hitting the big ones. This is the 1987 stock market crash. Obviously, from top to bottom, this is crazy. The top to bottom crash, and we hit this 200-week moving average at the bottom, which is this big yellow line. 200-week moving average is a great buying opportunity if you managed to do it back then. It would have looked crazy, and most people would have thought that you were crazy, but it turned out to be a good buy. The next week was a huge gap down, similar to maybe what we're going to have happen, but it was still in the range of the candle, and the week ended up closing green. So if we take the close here, 1993, .2%. But from the high point, it probably got up to about the 4% region. It looks to be about double. So maybe 4 to 5% to the high. This is one of the not as great examples, but there was a deep recovery the following months that this turned out to just be another V-bottom recovery. The same thing can be said, I think, of other corrections too. Even if it wasn't an exact bottom, there was a big recovery. You know, this is a huge recovery right here from September 11th. It wasn't the bottom of the dot-com bubble. It definitely wasn't the bottom, but it was a deep recovery. You could have bought into these. The most powerful rallies that you'll ever buy into are bear market rallies. We're not in a bear market by any means. We haven't seen all of this to be in a bear market rally. Months, years of sideways movement of just not making gains. We were at all-time highs less than 2 weeks ago. So the total gain over the course of, you know, the next couple of months was something like what, 10,500 from 82.50 about. %. And then obviously, you know, 1986. If I go back really quick to 2008, not so great. You still were not at the end of the bear market. However, before this week occurred, you had all of this, months, years, July 2007 to September 2008, at least 12 months of going down. That is not the case for where we are at today. Going further back in time, so already we're talking about week over week corrections of October 2008, worst month of, I think, the whole correction. September 2001, October 1987. These are all the big sell-offs of, you know, the last 30 years. So going back even further. Keep going. Some of these, you know, even 6% is, you know, pretty good, but let's just keep going here. This is May 1940, World War II. Not so great of an example, but it did have an amazing recovery over the next couple of weeks. So this correction was 14.2%. The next week was a gap down, a horrible one after already selling off. This candle on the final week is very similar to what we had for the stock market this week. However, we did not have this leading up to the sell-off. This is September 39 to May, so about over 6 months of sideways action running into the 200-week moving average, and also not even close to the previous all-time high, and World War II, okay? This is world at war. And so, but even still, the correction, the total gain, if you would have bought into that end there from 124 up to maybe if you sold at the 200-day moving average back test, which is this thinner yellow line, you would have done 134 from 124. %. Not bad. This is even more dire. July 1933. This is the bottom of the Great Depression. So this correction, 15.5%. If you would have bought into this, you would have nailed that bottom, and you would have gotten, let's see what the gain was the next day. The next week was 94.5. 6.5% week over week gain if you bought the close on that week. It was a gap up. The following few weeks, you actually made a decent return back to here, and it actually proved over time to be a tremendous, a really great buying opportunity. 88 stock market more than doubled in the next couple of years as we came out of the Great Depression. So this is 1929 stock market crash, and this is there's many more in this bear market of hitting these negative 10% weeks. But it was a different market back then. You know, you had stock brokers, no liquidity. You had to go through a broker and probably buy at the end of the day. I don't know how it worked back then. I wasn't alive back then, so different circumstances. But there's other examples of big negative 10% corrections. Even the one at the very beginning of the 1929 crash, which is this one right here, November 1929. This hit the 200-week moving average, which is this big fat moving average here. You would have had a gap down inside the range of the previous week candle, made a new low, and that didn't do so well that particular instance, but it did mark a significant bottom for a little while. And a common theme that I'm seeing is go back to test the 200 daily moving average, which is this thin yellow line right here. Went right up to that 200-day moving average and then came back down and broke the 200-week moving average, and we were in a bear market for a long time, years. So this still turned out to be a good buying opportunity back to the 200-day moving average. This was a beginning of a bear market. You still have to take into account that before this big weekly move, you had all of this correction already, 382 down to 382 down to 280. So the market was already 27% sold off from the top before they got to that time. Fast forward to today, this looks nothing like previous corrections. We were at all-time highs only 2 weeks ago, and we just made this huge move. DAX, I believe, hit that 200-week moving average. Right on that 200-week. And we're looking for these instances of 200-week moving average hits and a bounce back. I thought that the stopping point of this was going to be this back testing this big rail like S&P 500. It did not work. It stopped kind of around the 200-week moving average. We'll see if this holds. NASDAQ futures, by far the most promising. This is that same kind of rail that I was talking about before, connecting this top. We stopped on this rail. We stopped almost exactly on the 200-day moving average. The 200-day moving average was, if I go into this, it was 81.29, and the low was 81.26. That's pretty close. So we did penetrate it, which is great. We hit it. It really happened. Oh no, this is, I'm sorry, this is, here's a better picture probably. I need to get on a daily time frame to get it more accurate, but it's close. So that was really important that we got that. And this back test of this rail right here. Unprecedented volume. Even higher volume than, even if I put this on a log chart, it's not even close to the top to bottom anymore of February 2018. The volume is insane. So I am guessing based on the amount of dark pool activity and how much higher they pushed the final daily candle for NASDAQ, that NASDAQ is my primary target for the markets these upcoming weeks because they pushed it so far above. It was the index that did not penetrate the 200-day moving average. S&P 500 did easily. S&P 500's volume at the end of the session was great. This is a great candle, a huge pin candle, or a long-legged doji with massive volume. So from previous themes, going back up to the 200-day moving average is a near a 100-point move from the close on Friday. We have that same rail that we keep looking at from like DAX and other items that we penetrated. I thought the bottom could be here, right on this area up here. This 2.618 extension is something that goes back all the way to the financial crisis from top to bottom here. 2.618 is this value here. It proved to be big levels in the past, important levels by these Fibonacci levels. But this volume is nuts. It's on track with the February 2018 volume that we talked about, and I had that idea many weeks ago that we could be repeating after we repeat this this move here that I keep talking about. I call them S curves because I have no idea what they are. I just see them all the time, and they have a remarkable accuracy of predicting major tops. The signature move of these guys is you start off with a huge pulse up, huge impulse up. You have some kind of a sideways movement in the middle, and then you have a mirror image of sorts of the initial move, and then an Eiffel Tower drop off of the end that is a complete overbought sell-off. We had something similar back in February 2018, where we had this move that keeps going, and then finally it capitulates long and wipes everybody out and just completely wipes out everything. The Fed repo from September that started somewhere around here. Here's Fed repo starting September, completely wiped out. In my opinion, and also up here, by no strange coincidence, right here on February 20th was when Powell decided to come out with news that they were going to taper the Fed repo taper. Only saying we're just going to do a little bit less, not the end of the world, but that's what they wanted to do, and that was one of the other reasons. Well, I would definitely say is part of the reason for the top there to exacerbate this entire sell-off. It's no coincidence that days after this occurred that kicked off the top. The virus was known back here. This was the start of the virus, where I thought the original top was going to be, interrupted by PBOC buying $400 billion worth of treasuries to kick off a new high, which didn't make any sense. And then the Fed decides to do this and put the final nail in the coffin so that we could actually resume the February correction that we were supposed to have, just like this one that starts in late January and lasts only a couple of days into early February. Now this correction is delayed 20 days to end possibly on Friday. So we're back on track with this. This is what I think is going to happen over the next couple of weeks. VIX futures contango, which is just the front month minus the second month VIX futures contract, the percentage difference. We are hitting levels here that haven't been seen in a long time. So this backwardation level is huge. The backwardation is something like, this just doesn't happen that often. And you can go to a site online called VIXCentral.com and look at this is the VIX futures curve. Backwardation means that the curve is gradually sloping up to meet the spot VIX price, which closed near 40, nearing top. The top was close to 50 on Friday. In backwardation, the futures climb higher to meet it because the front month futures contract that expires must expire at the spot price of the underlying. So usually you're in contango, and this futures curve is gradually sloping up over time because futures are like options and have extrinsic value associated with them. And that decay slowly expires as you go further out in the curve. So contango is negative, called backwardation, when we're in an environment like this below that red line. So we're at a level here that doesn't get seen very often. So VIX puts, I think, on or VXX puts on Friday for maybe September expiration. When VIX goes to 50, it usually takes the ticker VXX about 4 to 5 months to be cut in half over time. It takes that's how long the timetable is for it to be reduced by half its price and revert back to being in a contango environment. So these are extreme levels. I wanted to I posted this link, and I'll post it in this YouTube video also. There's this guy online called Macro Charts that just started doing some work, and he reminds me of this guy that runs this private membership only chart feed for gold mining stocks, especially, called Rambus, and he's a really cool guy. And this guy has similar charts, and he is against a lot of the herd mentality that you see in the market. He was one of the very few people that I saw that were able to see that the amount of breadth that we had coming into this breakout here for the markets when we reached this point. When we were at here, when we were here, this looked like a major breakout. Because of this rail that we were breaking above, the breadth was great. The A&D, the NYSE A&D accumulation distribution line was increasing, making new highs. All through here was making new highs while the stock market was not. And it looked nothing like a sell-off was coming. And a lot of people were doing crazy things like, oh, I think that we're doing a megaphone, and we're going to do this. We're going to hit this and then drop all the way down to here. Why? There was no reason to drop down to there. There was no reason that was going to happen. So I like this guy's stuff. I'll post a link on this. Sentiment index at extreme levels. What is this? Futures versus 10-year ratios at extreme levels that you see maybe once every 5 years. A lot of stuff that doesn't happen very often. And all of these are pointing to the fact that this was a major bottom for all the right reasons. One of the things that I like to look at is this. I have all of these items that do alerts in the live channel whenever they get penetrated, including the percent above VWAP alerts that for some reason are remarkably accurate. This is percent stocks above 5 days. So we went through 50 day, 5 day, 20 day, 50 day. So if you go through all of these, the first one that we hit, I was like, okay, well, we could be hitting a major level here. We were above hitting levels that were above or below 10%, and we've managed to stay under that the entire time. The next, this is percent stocks above 10-day moving average, and the extreme levels are usually buying opportunities, quick pullbacks. This is one of the major corrections, so we're going to hit even bigger levels. So percent stocks above the 20-day, you don't see this very often, but when it does happen, it usually marks a significant bottom. So this happened in February 2018, of course, October 2018, December. If you go to the percent stocks above the 50-day, This is one that doesn't happen too often. This didn't even happen in February 2018. We got to a low of 9% on Friday about. And then, the matching December, but our stock market currently looks nothing like December. We were selling off for weeks. If you go back to January 2016, that was another one. And then remember, 2015 was a horrible year. If you look at S&P 500 in the background in yellow, it was drifting sideways. QE was ended somewhere around the beginning of 2015. Markets hated it. They're addicted to Fed money. Every time QE ended from 2009 to 2015, the markets did a 20% correction. That was 2011, 2010 flash crash, 2011 they ended QE2, and then 2015 QE3 was ended, and we had a big correction. So these levels here in August 2015, and then right before and right near the new year of 2016, we had that. So 2016 is another example of an early correction in the year in February or January. It turned out to be a great buying opportunity back in 2016. In February, that was a great buying opportunity for the rest of the year, in fact. VXX puts all year that year were great. Every month you could have done VXX puts, sold them 1 week before the VIX futures expiration, and made a lot of money. So I would go through this document that this guy just released today. It shows a lot of extreme levels. It shows a lot of reasons why we could have a huge bounce. NYA is the NYSE composite. We hit a huge level here. Big support level. 200-week moving average is in yellow. We keep seeing this. And usually the minimum move back is the 200-day moving average. And if you calculate that, 13,210. It's about an 8% move back up to get to that 200-day moving average. The 200-day moving average will slowly drift down every day as long as you're underneath it, but this is a big support level. It's right in the middle of this big range, I think. Right near the middle of it. A little bit below the middle. Even better that it's a little bit below the middle. It might be 61.8% actually if I do this upside down. 61.8% was near the exact bottom on Friday. That's important. So this correction was 61.8% for the NYSE composite. So that you've just got a bunch of reasons. I talked about this movement here with the 200-day and the 200-week. This still looks like a bullish scenario. We were at all-time highs not that long ago. The only thing that can be bearish about all of this is the fact that we broke out above this high and then gave it all back. A lot of the times that's a complete fake out. That's not something that you want to see on a bullish breakout move. You want to see it keep going. You don't want to see it break out then come back in. That's a fake Wyckoff upthrust that usually doesn't end well, but we'll see. Gold, again, we talked about. This is very bad. This is going much lower for this weekly correction. We hit the year Camarilla R3 or R4 to the day on seasonality. The exact day for seasonality ends on February 24th on average for the 10-year seasonal profile. February 24th was the top. This is the seasonal profile in yellow for gold. On average, you go up from the final FOMC in December, near middle of December, accelerate through January, have a top near February 24th, and then descend into the next FOMC statement, which is on March 18th. Obviously, this correction is much larger magnitude. Again, seasonality is just average of the previous 10 years in this case, 10 years from 2010 to 2019. But on average, that top is that date. That year R4 marked that top. This is the 50 week 50 week moving average, or 50-day moving average, I think. Yeah. This this setup right here is a complete horrible rejection. It's going to get worse. This is not going to get better. My minimum target is back at the previous close. My ultimate target is here, 1440. Year cam S3, Camarilla pivot S3. Back here to the 200 week moving average or so. This candle setup, minimum target last year's close in December. This candle setup is a horrible candle setup. This is a complete Wyckoff upthrust. You upthrusted and then managed to make a bearish engulfing red candle for the entire week on gold. This is just the beginning. Short all pullbacks is what I would say. And the miners are showing the way. Miners were killed. Miners topped on year cam R3 almost exactly and gave up everything and came all the way back down. They're going to go to year S4, $34 or so, and probably keep going. I think that it can get all the way back to $30. I think it can get back to this low, or this region right here. $30 is where I think it can actually go back to. And if you pay attention to seasonality, we can actually have a worse than average year this year for gold, maybe. All the way up until May 22nd would probably be the minimum time to buy back into gold to catch this summer move that happens from here to here. So I'm looking for these buying opportunities this week. I think that we can get a 5% move back up. YM is very interesting because YM is Dow Jones Futures is the last thing I'm going to talk about. This was not a great prediction. I thought we could bottom on year S3. We did not. Year S4, we definitely seem to have bottomed on. It just so happens that the 5% move back up is the secondary Camarilla trade that I always talk about. 5.7% back up is year S3 for the Dow Jones Futures. And that would be about on par with the average gain after a week like this. So we had 7 red days in a row. 1, 2, 3, 4, 5, 6, 7. 7 red days in a row. You're going to see something happen on the next day, most likely. The volume is completely peaking out, and it had even more volume on the final day. If you look up the dark pool activity for SPY for the previous 4 days, there's a big level at 311.56. If I pull this up, I can actually pull this up in the equivalent of ES and get the conversion for the previous 4 days. The volume stays the same, but the prices are different. 17 million was at 311.56. That was February 27th. So late prints from February 26th. This is about that same level. That close on February 26th for ES. The late prints come in a day later, so it's not. They came out on the tape on February 27th, but they actually belong to the close on February 26th. 311, 3112, 3112. About here. But I like the fact that on Dow Jones Futures, the close for February 26 is also right around this Camarilla pivot year S3. So that's my target, 26,800 for Dow Jones Futures this upcoming week. Maybe we hit the 200-day moving average, which I'm not sure where that is. That's about, I think that we can backtest that on the underside. And if we fail there, that means we have even more downside. But I think that we can get back there. So this region right here is the target. this region, somewhere around here, is the target. Year S3 minimum back test, and then somewhere around the 200-day moving average, somewhere around the February 26th close. Somewhere right there is I think that we can get back, as a place I think we can get back to. Okay, thanks for tuning in. Good luck tomorrow. Let's see how we open. We're still down 500 points right now in weekend Wall Street. They could push this back up towards the open and open us green at 9:30. I don't know. I'm staying in. I think this is a great buying opportunity. I'm looking for 5% over this week or the next week as a gain.